Ladies and gentlemen of the crypto space, we're live on a Friday, June 3rd at 12:05 p.m. This is the macro situation rundown, how to not blow up your damn portfolio. Do you think this is May of 2020, where there was unlimited liquidity just being sloshed around like a swimming pool during a hurricane? The liquidity is drained from the system. I'm not going to completely make your brain numb with the bond charts and derivatives talk and the dollar, albeit a good part of risk assets run inversely correlated to dollar price movement and the DXY, and more specifically, even though the DXY is predominantly euros and yen. But where are we in the damn cycle? This is not May of 2020, but what do you got see? What do you see going on? A whole lot of innovation. You got Tetranode doing all his Tetranode type things. You got optimism rolling out. You got a fair amount of stuff going on BTC sidechain. Syscoin did some nice price movement, and a variety of the more Bitcoin maximalist friendly type of projects becoming more popular. And this is all good to see. There's a massive amount of innovation. Now, this is not a market where it's like, holy crap, this changes everything, and you buy it and you make money. That it's not going to work like that. This market doesn't work like that. This is not May of 2020. This is more like the early Q1 of 2019, where we've had some really big rips to the downside, and it's basically going horizontal, and you're in, I hope it doesn't go down anymore mode. And this isn't a market where it's like, oh, it's bottomed, it's going to start going up. After you find bottom, it doesn't start going up. After you find bottom, everyone's like, woof, it's not bleeding anymore. So this is not a market where you're buying stuff necessarily. And as Arthur Hayes says, I'd rather wait for the all clear. I'd rather wait for the signal that says, all right, now I can buy because it's going to go up, or it's flipped, it's found bottom, and it's starting to go up. I'd rather buy 50% higher prices than they're at across the board right now, with an increasing level of conviction, more confluence suggesting bullish continuation. And this is why we have the trifecta of bullish confluence, where you have a previous resistance, a retest, and resistance flip support, and a higher high. The trifecta of bullish confluence, one of our earliest capital gains quotes, or however you want to define it. So, as I've said many times, this is a market for evaluation, identification of survivability. What's going to survive? Let's pop it over to the main screen and figure out how to not blow up our portfolio. So that was I think, whatever chart that was. But there's incredible innovation. And look at Alchemix. Alchemix is very, very interesting. And they're throwing around a fair amount of bribes. And in fact, they're using, not bribe protocol, where is it? Here. The Warden. So they're throwing around yield, but it's sold out right now. But this is interesting, and this is a tweet I just did a little bit ago about the resale market for voting, and it's been commoditized. Obviously, the curve inflation has been commoditized, but even the bribe market is basically a commodity. People are paying people for their voting power. And there's three bribe markets right now for raw VE curve, not even VL, CVX, and derivatives, so on and so forth. You have the Warden, app.warden.vote. You have not hidden hand. You have pitch, which has a curve market, but there's no work being done. There's no bribes going to the pitch market right now. But then you have Vodium, which is the evolution of what Andre created, and convex is thrown on capital as well as synthetics, and it's a fair amount. It's 1.19 cents per VE curve. And that's a lot because that's quickly become competitive with the payout rate for the CVX incentives or payouts. And that's quite interesting to see. Um, you know, you go back and forth in your mind about What's going to outperform? What's the new technology? What's the next greatest thing? When we have these crazy ass opportunities sitting right in front of our face. And the bribe market is really what I keep going back to as being one of the most important markets that has emerged in the crypto space. Now, what happened with optimism? Balancer and Beethoven launched on optimism. So you're like, oh my God, they launched on optimism, and all of a sudden, Beats is going to go to infinity and no, they deployed meaningful technology, and it's awesome to see. In Discord, I talk very highly about Beethoven because it's one of the few protocols that has achieved anything remotely comparable to Curve with regard to a federation, with regard to an early stage um, bribe market for the voting rights. They're not quite there yet. They're on primarily Phantom. They just expanded to Optimism, and it doesn't have the moat. It doesn't have the momentum. Doesn't have the market favoring it right now, and thus we've seen the depreciation as a result. What have we also seen with regard to Curve? Curve has significantly depreciated, but it didn't blow past May 21's lows, a remarkable amount of support. We have our metrics from Dune Analytics regarding curve emissions charted against VCRV quantities, and that's a breathtaking piece of analytic quantitative data. And that is our point of reference. That is our base comparison for these other markets that folks often think of as, oh, this is like that. This is the next big thing. No, no, it's something that's comparable to something that has proven to be successful, that's entrenched with a moat, but it doesn't mean it's going to go up in a straight line. It doesn't mean it's not necessarily going to hit lower lows. All it means is it's really cool technology and it's something to watch. And we go back to the whole point of the stream, which is how to survive and how to not blow up your damn portfolio. This is a period of time to observe and evaluate what is being produced, the new technology, the new systems, how much traction and momentum and adoption are they getting, and and that's going to prevent you from blowing up your portfolio. What if we have a massive thrust down and a giant wick and Bitcoin dips to $22,000? Everything else is going to get completely annihilated. What if? What if it doesn't? You can drive yourself nuts trying to think about all the what ifs in this market. You're people are still overwhelmed with a bit of intoxication that, oh my God, I'm going to get into something that's so cheap. I'd rather buy higher. I'd rather buy higher. Isn't that a bit of a contrarian take? I want to make less money. Why? Because making less money often makes more money. If you try and make more money, the odds are you're taking on increased risk, and fewer people than more come out of that type of idea with gains. Most people that take on excessive risk lose. And I don't want to take those risks. I want to make 10% of what I would hope to make. And I'm more likely to achieve that than if I put 50% of the portfolio into some really hot altcoin on a side chain. Um, I don't want to make $100 million. I want to make $100,000 every year. If I could do that, I'm going to be able to have a sustainable lifestyle and I'll be able to achieve exactly what my goals. I think one of the most important things I've found over the last months, maybe the last year or two, um, is what I'm really interested in. What are my goals? What do I want to achieve? And everyone's like, I want to be rich. What are you going to do if you're rich? You're going to spend money. If you spend your money, you no longer have it. So that's why I talk about these revenue streams. Because if you're making 20 grand a month, do you need more? If you're making 20 grand a month, you could mortgage the shit out of $1 million home. You could drive a Ferrari if you want, pay for kids' college. All right, fine. So you still got to balance your budget if you're making 20 grand. But if you're making 20 grand a month, do you really need 10, 20, 30, 40, 50? Do you need millions of dollars? You don't. you're making 20 grand a month and you're still working and you're making an extra 5, 6, 7, 8 grand a month working, that's a massive, massive amount of money. I truly believe that folks have irrational goals. You wouldn't even know what to do with a couple $1,000,000. You wouldn't want to spend it. Why? Because a couple $1,000,000 has a capacity to generate a significant amount of revenue as a business, as an enterprise, which is exactly why I focus on business and enterprise. And these are the types of conversations I have because these are much more sustainable ways to interact with these types of markets. So anyway, I hope that helps. I know folks have criticized me for, oh, how did I get the amount of capital that I have that generates the amount of money that I have? And sure, there has been capital gains along the way, but for what it's worth, it's all documented. Everything I've ever done in the crypto space is on these YouTube streams. So the whole journey has been documented to how we got from where we were back in May, earlier March of 2020 to June of 2022. That'd be interesting if I had history with the earlier markets, 16, 17, but I don't have anything other than good old personal memories. 30 people in the stream, 7 likes. We can do better. That's the curve chart. We can do a little bit of macro. What catches my eye is bonds, obviously, because bonds are selling. And I love Luke Roman's thoughts about a sovereign debt crisis because if bonds are selling, why are they selling? Because the damn derivatives market is deleveraging. It's the only market in the world that's able to absorb the quantity of bonds that are issued by these sovereign countries. So if the derivatives market isn't expanding, and how do we know the derivatives market isn't expanding? Um, where is it? Where is it? Yeah, because the derivatives market's not expanding. The biggest piece of metrics, biggest piece of analytic data I'm looking for is H1 20. Is that? No. It is H. No, it says H second half of 2021. I want H1 2022. That's what I'm itching to see. And if we see this fall, which is primarily the total, which is primarily interest rate derivatives, if we see it down at 400, 450, dare we see it down at 250, 300 trillion dollars, that's going to indicate a significant risk aversion in the derivatives market, which means they're not buying the bonds. And if they're not buying the bonds, how the hell are these countries going to finance their deficit spending? And that's extraordinary. That means the paradigm, it's a secular transition, a secular shift. The whole system is changing. So that doesn't directly relate to the activities we do in the crypto space, but that's indicative at the highest of levels of change that's inbound. And we've heard the WEF and variety of institutions and large commercial banks really talking about crypto more and more because of the potential, the opportunity to generate capital, to generate enterprise, to give people purpose and meaning and things to do and keep them occupied. Because really, all a damn financial system, the purpose of it is to keep the population active and maintain social order. So if everything's contracting and the governments can't deficit spend, they need something else. And that's where crypto comes in. So, it, I had a nice conversation last night with a good long-term follower. Um, and I was talking about you don't need to do anything in these markets, in my opinion. And it's really what I do for myself. I have my positions, I have cash flow, and I don't need to do anything to know that the portfolio is going to be where it's going to be in 5, 10 years. Because just having the existing portfolio is exposed to these macroeconomic trends. And the trend is more likely than less that the crypto space is going to be used much like Eurodollars. Eurodollars were originally created to fill the gap with regard to currency availability. and that's what Jeff Snyder talks about with regard to the extreme disinflation, and that's why we don't have that. That's why we have our trends when the euro dollar curves invert. There's less. There's less liquidity going to be available in the future as per the curve's timeframes. And if there's less liquidity, uh, there's more fear, there's less capital available to purchase risk assets, and it generally is indicative of a contraction that's going to occur in the markets. If there's a contraction, risk assets sell off, and it doesn't mean bonds are getting bought. So for a long time, for a good part of normal market history, risk off was the purchase of bonds. But what I very firmly believe is that, especially as of late, it doesn't matter how many people or even companies or institutions buy bonds. The only market that's capable of absorbing the amount of bonds these countries need to print is the derivatives market. You're talking about $598.42 trillion dollars. So they need to buy $2 trillion worth of bonds. Okay, so they buy $2 trillion worth of bonds, 4 trillion, 10 trillion. This is a $600 trillion market. That's not being bought by Wall Street. That's not being bought by mom and pop with savings bonds for kids. So it's really just the derivatives market. So everything's on the verge of change. This is not a time where I'd be deploying capital that you need to pay for bills. Wait for the signal. As Arthur Hayes talks about, wait for the signal. And the signal probably comes in the form of Fed capitulation. And it probably doesn't even come in the form of like explicit capitulation. It comes in the form of hints of capitulation. And a good initial hint of capitulation is the pausing of rate hikes. And why would they pause rate hikes? So they don't tighten anymore. This is the fastest period of tightening in history. And the market did it. It wasn't the Fed. The Fed fund rate is at 0.75. The market tightened itself. It constricted and contracted the amount of liquidity by itself. The Fed didn't even need to do anything. All the Fed did was talkie, talkie, talkie right out of its butt. Let me answer some of you guys' questions and see if I could help. Good afternoon from North Macedonia. It's a beautiful world. It's a pleasure to have you, Garo. Vasco, hey, Noah, what do you think about Arthur Hayes' Medium? Yeah, I think that article is extremely well written. He is extremely smart, and it has combination of a variety of narratives that some of my favorite macroeconomists talk about, and I agree with him. I don't give a shit about bottom. I don't care where the bottom is, and probably the bottom is around where he said, like 2,500 on BTC. All right, great. You get a wick down to 19 grand. That's going to scare the pants off of people. That's going to shake a lot of people out of positions. That doesn't mean if you wick down to 19 grand, that doesn't mean bottom isn't 25. That means you didn't have a damn wick down to 19 grand. I like that article a lot, and I think it is a great evaluation of current market conditions and likely directionality. And I agree with him also about an absolute blow off top and then a collapse of currency. It just completely implodes, and then that's where the WEF steps in with its new system that it wants to deploy. So I think he's spot on. Listen, if the Fed is forced to do liquidity injections like it did in 2020, it's going to be 10 times as large, and it's going to be the last time they're going to be able to get away with anything like that. The system will completely unravel at the seams if they do anything like that. That was the sloppiest deployment of liquidity I could possibly imagine. We see better deployments of liquidity in the crypto space than we did in 2020 of what the Fed did. It was just a complete catastrophe. The capital did not get even close to where it needed to go. The most inefficient deployment and imprecise deployment of capital I could possibly imagine. I mean, literally, crypto does it better than what they did in 2020. That's crazy. And that's why the WEF is eyes on the power of a capacity to distribute liquidity with precision and capital controls to govern inflation and deflationary pressures throughout a society. With literally, if the government did a centralized contract implementation, and just like we deal with, what do you think a V curve position is? It's goddamn capital controls. It's forced holding. Changes everything. Changes everything about an economy. Everyone rather catch the knife by the dip, brah. Yeah, the only thing I'm going to do with a knife is I'm going to cook some food. And it's not dip buying. Oh, what a waste. Wait for the market to start going up, boys and girls, and stop cutting yourselves. Do yourselves a favor and just chill. Listen, in May of 2020, you could literally buy anything, and it was just going vertical. If that was the market condition we had, we know we'll have it again. We'll have irrational exuberance again at some point. We could just buy anything and it's going to go up 5, 10, 15, 20, 30, 40, 50x on the money. Why the hell are you trying to play a market like this? Why the hell are you trying to find bottom when you had a market that you could buy anything and just ran multiples? Joseph, I think it's pretty good. I could see the audio capture thing ticking. Might be just local on your machine. Jake, Noah, what's the bear case for CRV? What's your mind makes the most likely not to succeed long term? Well, as curve depreciates, the yield on LP positions depreciates, and that'll drive capital to exit. So what you'll end up seeing is total liquidity in the system decrease. Nope. We go here. We'll just go to the main screen. Nice and simple. Which it has. We've seen about 50% of the liquidity in curve evaporate, especially with Luna's collapsing. But it's got $8.7 billion, and these yields are still extraordinary. I mean, you get it 4% on dollars. Yeah, it sucks for a person with $1,000, $10,000, but if you have $10 million, what are you going to do with $10 million? You're not going to buy. I wouldn't buy assets in this type of market, so you park it and you get it 4%. You're like, oh, that's 4%. Yeah, 5% with a little bit of risk exposure to the Frax ecosystem, and what is that risk worth? It's worth 1.86%, and then the person evaluates their risk tolerance, and maybe they expose to it and SUSD exposure, a little bit of tether exposure. You got plenty of options and choices on Curve, and this is Curve directly. You could go to Convex, and what I would highlight is stuff like the compound pool, which is old school, which is DAI and USDC, which is 1.85% with $90 million. What are the biggest pools in here? I'm very curious. Can we sort by TVL? Yeah. Frax has $1.5 billion, earning 5.89%. You could throw $100 million into there and get 5.89%. It'll probably dilute down to like 5.25, maybe 5%, 5%, and that amount of capital. So, it's hard you have to play your hand. This is a poker hand, you play in your hand, but in order to play your hand, you have to know the other people's hands. So what are the other people's hands? The other people's hands and the people that move markets that have the big hands are the big whales. So at minimum, you have to understand or at least conceptualize what the hell they're doing and why the hell they're doing it. And that's why capital stays, because $100 million getting 5.5%, $1.5 billion getting 5.89% changes everything. And then as Curve appreciates, if Curve doubled in price, oh, bam, that's 10% of the money. Whew. This is an extraordinary, game-changing number in a bearish market. Changes everything. So we can look at the chart with regard to price action and where's bottom and what is bottom? You're going to buy bottom and wait for the Fed to have a liquidity event, to have to inject $20 trillion for it to go up. I get tempted all the time to buy more. And what I know is it's a period of austerity, so my income has decreased. Revenue from VE curve transaction fees is down, which is not that bad. $1,600 a month. That's nothing to sneeze at. Pays for the cars. Um, so it's a period of austerity. What my expectation is decreased revenue and depreciation of the portfolio. So my position is I'm here to identify sustainability and survivability. What the hell is going to continue to exist? And during the entirety of this bearish market, however long it lasts, I'm getting a damn income. I'm not really thinking much about the portfolio balance because when in a bullish market, the portfolio goes up in value. So whatever goes down and depreciates is going to inflate and reappreciate. And throughout the entirety of it, cash flow to pay bills, to live my life, to accumulate savings, and then you could get into a whole, conversation about how to denominate savings and so on and so forth. And that's a very complicated philosophical conversation that is the favorite topic of Bitcoin maximalists and frankly UTXO and hard money maximalists. And I'm not too biased against fiat currencies. I know I say many things, and one of the things I say is biases won't cause good results. So if you see a bias like fucking garbage dollars, just drop it and work with the system, play the game. So clearly, if you have period of high inflation, dollars are depreciating over time, so you probably don't want to hold dollars too much. And if you're holding for too long, for a year, if you're going to lose 10% of your money in a year, that pretty much sucks. So you need to navigate that, which means you have to either have additional income and save more with knowing that you're going to take a 10% haircut over the course of a year, uh, or you diversify your savings into different denominations. Um, and Bitcoin is on the table, gold is on the table, some, and enterprise, which is my focus. And I think the best form of savings is enterprise, is owning parts of companies, and I equate these digital protocols with companies, and we own them. You're getting a piece of the company's revenue. And that means everything. It's an interesting conversation that just goes off in so many directions. It's complicated to tell this story. I hope it comes through as clear as possible. So, bear case for Curve is that it survives. That's all it needs to do. It doesn't need to outperform. It doesn't need to go up in value. It doesn't need to do anything other than what it's doing today and survive. And if it survives, this becomes Lindy. It becomes entrenched infrastructure because it was the first to commoditize inflation. And that's all it needs to do. Dan's in the house. How are you, my friend? I took down AskVid. I'm sorry. I canceled all the subs to AskVid, but the dev didn't want to maintain it anymore. So, but that's the story with that, Dan. I don't think anyone's going to get a place where they only need passive income streams to make it without cap gains play along the way, unless they're starting off with a large cash position. Yes. So I'm sorry that I don't talk more about technicals. I don't talk more about capital gains. We used to do capital gains. And believe me, if I see a big capital gains opportunity, I'm going to take advantage of it. But I don't short markets. I don't do perps and derivatives and leverage. I don't do that stuff and options. So I'm not into capital gains, and you're absolutely right. Now I got to where I am probably because of capital gains, mostly because of capital gains. But in hindsight, I don't know how the hell I got to where I am, and I'm very grateful for it. So whatever you do, I wouldn't do it in this market. If you're going to play capital gains, look back on our old videos when we were playing Matic and we played Rook. I got a whole lot of technical videos about Rook and Matic where it was very, very. I was screaming about the technical setups, and I think we made 500% on Rook and doubled our money on Matic, and it was just massive capital gains that you can only do during a bullish cycle. And then so we did that. We've been there, done that, and we all did it together, and that's how we got to where we are. Nickel is in the house. An Italian boy is in the house. One curious if you enjoy the weekend. Yeah, thank you. I need to unplug a bit. It's been a short week at the office, but it's still not easy to. We do what we do. So keep working, boys. If you make money, don't forget, keep working. Don't stop working. You need to work. Hey Noah, have you changed your portfolio allocation during this bear? I haven't done a damn thing except take in yield, take in revenue, take in income, and sell it for stablecoins. And those stablecoins, I got a BitPay card. I'm able to spend money. I'm able to go to the store. I'm able to pay bills. So I have done nothing other than that. I've been tempted. In fact, the other day I bought a curve position and I sold it because this shit happened. The TWAP didn't look strong enough. I was hopeful that this would hold the support, but it clearly didn't, and it fell a fair amount. That would have been based on the position size I took, that would have been a $10,000 loss. So I got out of that with maybe a $2,000 loss. Do I want more? Yeah, and that if I want more, that ultimately means to me I probably don't need to buy anymore. As a contrarian, that probably means to me, should mean to me, that my current position size is where it needs to be, which is the same position and portfolio balance that as I show on Discord. So I'm probably in the best possible configuration because I haven't made any changes. I haven't bought anything, and I've only sold my yield. Bear in mind, it's not easy. Yield is unless you. So one of the most important topics I talk about is compartmentalization of the portfolio. Different parts of the portfolio serve different purposes, and there's three parts of a portfolio. There's cash position, which is your savings account. You have ownership of cash flow, which is like a V curve, V bow, pick whatever the hell you want to pick. And these things produce revenue. Um, and that revenue should get added to your cash position. That cash position can be used for capital gains opportunities. So if you compartmentalize the portfolio, does it matter if V curve goes up and down in value? That value is irrelevant. What's pertinent is how much cash it produces for you. So you could increase your savings. So you could use that to potentially do a capital gain strategy to make 1, 2, 3, 4, 5, 600, 1,000% on your money. Clearly not in this market. In a bullish market, there is no capital gains in this market unless you're on a derivatives exchange doing 1, 10, 20, 50x leverage. And the odds are the vast majority of persons engaging in that behavior lose their money. So again, and probably in conclusion, the best advice I could give is just wait. Wait for the all clear from the Fed. Wait for the dollar to take a dip down and just keep going down. They need to systematically devalue the dollar, otherwise foreign currencies aren't going to exist and the dollar is going to crush everything. And I'm pretty sure every country around the world right now is screaming at the Fed, cut your damn rates. Just open the swap line. Send us some freaking dollars. There's a dollar shortage. How about that? Everyone has such animosity for dollars that they print so many dollars, but there's not enough dollars. There's more demand for dollars than there are available. That's how this dollar chart goes up in value. So we complain about hyperinflationary emissions of various crypto protocols, yet imagine a crypto protocol where every other protocol buys it. That's the dollar. The dollar printed more dollars in history, and every single one was bought to the point where it still went up in price. That should put something into perspective. As a very crypto-centric perspective, because we deal with these hyperinflationary protocols all the time over the last 2 years, and mostly they go straight down. But pick a damn asset that's hyperinflationary that goes straight down. Unfortunately, Stargate went straight down. I mean, come on. Lovely token, lovely technology, but the monetary policy was purely inflationary. There was no reflexivity, there was no incentive, there was no to lock it, to disrupt supply, to have a capital control, MMT type concepts, and it was just sold for yield. So the dollar didn't do this. The dollar's up. So why is the dollar up? Because it's being bought. Because everything that was emitted, everything that was inflated, was bought. So the dollar, we could be angry at it all we want because it's hard to make them. It's not as a shitty of an asset as most people make it out to be. Inflation is another story, consumer price inflation versus currency inflation. That's the biggest misunderstanding there is in the market. We have a disinflationary, the dollar is disinflationary. It's less inflation over time, even considering the massive inflation we've had over the last 2 years in currency. It's still disinflationary. That's how much demand there is for the dollar. And that is one of the most important things that I've learned digging into macro, listening to Jeff and Emil, and put the biases aside. Just put them to rest and understand these components of this large macro system. Crypto is a part of the macro system, albeit an infinitesimally small part, and uh, and understand them for what they are. And that's how you navigate these types of markets. Um, Last question. Booster, a lot of people in text are brushing off recession as doomer talk. High income still not impacted yet. Do you think worse is to come for tech correction? Now, we can look at NASDAQ. Um, I think that, this is Luke Groman's wheelhouse because, if NASDAQ collapses, who owns NASDAQ? It's retired persons and boomers and pension funds and 401ks and I mean, come on, if this thing is 306 and this thing collapses to 150, people just lost half their money. If you're 75, 80 years old and you just lost half your money, so this isn't a chart of tech companies. This is a chart of American um, baby boomer and retirement population solvency. If that generation of retired persons loses half their money, it jeopardizes retirement. So there goes the entire incumbent class of Congress and the House of the Senate. Uh, Congress will be completely wiped out, and you'll have a rollover of everything because they're on watch as the retirement, the safety net of or the needs of the retired population is completely decimated. So what you hear, you might think you're looking at tech stocks, but you're really looking at um, politicians' capacity to get reelected. This is a whole political chart. This is a whole health of the retirement population chart. It's not just a tech chart. Stocks on tech. The amount of politics in this chart is extraordinary. All right, let's wrap up. When Rube stable? Probably at some point. 39 people in the stream, 15 likes. We can do better. As always, I thank you all for joining me. Friday, June 3rd, 12:43 p.m. Tell everyone to subscribe. After party on Discord with the most rational community in the entire crypto space. That forum is going to be hot during the next bull market because we got folks in there that have so much damn experience from the last year or so that the forum's been online. It's just extraordinary the growth, the rationality, and the professionalism that folks have demonstrated in the forum. Now, obviously, some prominent folks have left, but they'll be back because it's the most rational community in the entire crypto space. I wish you all a wonderful weekend. NoahCyber.com. If anyone needs any one-on-one help, I'm more than happy to help to the best of my abilities. Probably just going to be convincing you to not buy anything in this type of market. I will see you guys on Monday. Y'all have a good one now. Peace.